Just to follow up on last week before we head in, I had asked if there was any interest in an energy sector designation, and I got very good response on that. So I have begun the process of creating the videos for each of the readings. There are 14 readings in total. I've done the first video and moving on to the second. So I'm going to launch that one January 1st. $325, that is with the exam fee included. Exam fee is approximately $100 to $110. You have to buy in packages. You can get it as low as $25. You can get as low as $5 if you're willing to buy like 30,000 at a time. That's really just a university doing that. The smaller that you commit to, the smaller the amount, the higher the price. And as soon as you go over 3 hours on an exam, the price goes up even more. So I don't see an exam lasting more than 3 hours on this one. I'd have to design one under 3 hours. And you have to pay up front. So if I took like 150 of them, I'd get somewhere around $100 per exam. So we'll launch January 1st at $325. That would include already the exam fee. For the applied level, if you do all have the applied level, you'll have access to all the content. If you want it, you just pay the exam fee, which, like I say, is about $100 to $110. Applied analysis and applied asset management are the two modules that the applied level has. Some of the content is in applied analysis. Some of it will be in applied asset management because some of it is analysis and some of it is actually trade execution. They're $425 each. If you are in the CFA community, you're a candidate or you're a member, level 1, level 2, level 3, or full charter holder, you get $100 off each one. And if you are an mm.com subscriber at level 1, level 2, or level 3, you get another $50 off. So you're down to $275 per module or $550. If you just want the energy designation itself, $325. The exam fee is $110 because you'd have to pay the exam fee over here. So if we took it off over here, you're really only paying $215 US for the core content, and you can sort of size that up against the $550. I also will be doing a mining sector designation as well, because in the mining sector we have quite a bit, and I am following the GICS code. For mining, we have aluminum, copper, gold, precious metals, silver, steel, and of course diversified metals in mining. Also within there, you'd have to include refining and streaming companies and trading houses to make it complete to understand the mining sector. So that will be coming as well. If you have the applied level, any of these that I introduce, you'll get all the content for it. You would just be paying the exam fee. And the nice thing is the more of these that I introduce, people are taking the energy sector and then the mining sector, you have a higher number. I can then get this fee lower each time I have more people signing on. I'll have more information on this as we approach January, but I will be probably putting it up for pre-sale in early December, and then the official launch in January. Let's start here. This is two of Trump's, can't call them tweets. I just feel weird calling them truths, but with big air quotes, we'll call them truths. The first one is this one. It was a really long one. I'm going to skip the preamble and get to the more interesting part. Talking about China sending out notices about some export restrictions. This was a real surprise, not only to me, but to all the leaders of the free world. I was to meet President Xi in 2 weeks at APEC in South Korea, but now there seems to be no reason to do so. The Chinese letters were especially inappropriate in that this was the day that after 3,000 years of bedlam and fighting, there is peace in the Middle East. I question the 3,000 years. I don't think it's gone on for 3,000 years. Peace in the Middle East, comma, for now. Anytime you say that sentence, there are many sentences that you have to end now with comma for now. Since I have been a young boy, Old enough to hear the 6 o'clock news. Always unrest in the Middle East, the peace process in the Middle East, followed by unrest in the Middle East, followed by the peace process in the Middle East. So, peace in the Middle East, comma, for now. I wonder if that timing was coincidental, dependent on what China says about the hostile order that they've just put out. I will be forced, as President of the United States, to financially counter their move for every element that they have been able to monopolize. We have too. I question that. I never thought it would come to this, but perhaps, as with all things, the time has come. Ultimately, though potentially painful, it will be a very good thing in the end for the USA. Either get rid of the ultimately or get rid of in the end. Bad grammar. One of the policies that we are calculating at this point is a massive increase of tariffs on Chinese products coming into the United States of America. There are many other countermeasures that are likewise under serious consideration. Thank you for your attention to this matter. And then followed up with this one here that just tanked the market. Thank you very much. I'm good with that. It gives me opportunities to buy good things that are being thrown out. Plus, this is typical Trump. Threaten, bully, don't get what you want, taco. And I'm sure he'll taco on this one too. It has just been learned that China has taken an extraordinarily aggressive position on trade in sending an extremely hostile letter to the world stating that they were going to, effective November 1st, impose large-scale export controls on virtually every product they make. Not quite true. And some not even made by them. Not quite true there either. But yes, China is going to put export restrictions on certain critical things. This affects all countries without exception and was obviously a plan devised by them years ago. Absolutely unheard of in international trade and a moral disgrace in dealing with other nations. I wonder if the administration has a mirror and if they ever look in that mirror. A plan devised by them years ago. It sounds like Trump. What he's doing now was a plan devised all during the Biden administration. A moral disgrace in dealing with other nations. Remember Liberation Day? You're going to pay this and you're going to pay this, and every country in the world is a threat to America. They've been ripping us off. I wonder if they ever look in a mirror. Based on the fact that China has taken this unprecedented position, speaking only for the USA, not other nations, we can skip a block, November 1st or sooner, depending on any further actions. The United States will impose a tariff of 100% on China over and above any tariff that they are currently paying. First of all, China does not pay the tariff. Let's not let that propaganda fool us. China does not pay the tariff. Let's say it the right way. We will impose a tariff of 100% on any of our citizens buying Chinese product. We will make our citizens pay dearly for ordering Chinese product. That is the better way to say it. Also, on November 1st, we will impose export controls on any and all critical software. Impossible to believe that China would have taken such an action. But they have, and the rest is history. Thank you for your attention to this matter. And then later that day, Office of Management and Budget, OMB, led by Russell Voigt, posted on X, the rifts have begun, reduction in force. And Wall Street Journal reports that on Friday, 4,152 notices went out. They can trace some of them to housing, health and human services, 1,100 to 1,200. Treasury, 1,446. They hit energy, commerce, housing and urban development, Homeland Security and education. Homeland Security, it's their cybersecurity division that they're downsizing. Not very bright. And apparently some of the notices they had sent out to the CDC, they had to rescind about half of them. Some of those people got an email about half an hour later saying, well, it was a mistake. It was a mistake. We didn't mean to fire you. Come on back. But Friday they have started, and more coming this week, they say. And on the weekend, Trump posted, military is going to get paid October 15th. He had directed the Secretary of War to find the money, and I guess it's going to come out of the research budget, but they are going to pay the military on the 15th. And this is what started it all. The longer the shutdown goes on, the more it's going to eat into fourth quarter GDP growth, the more it's going to affect the sentiment of other consumers, other investors, and this volatility here. What is interesting is, I guess there was a big short that was noticed in the crypto market in both Bitcoin and Ethereum, that somebody was shorting it to 1 minute before this post was released, and then started covering their short. Come on, come on. Something like a $150-200 million profit on that. And this was known Thursday, but this didn't happen until Friday. Because, of course, if you find out Thursday, you can't retaliate Thursday until you and your inner crew get your positions in the market done first, and then you announce it. This group of people are getting very, very rich. Okay, on this screen, I've got, I think, something really critical that seems to be brewing. We'll talk about it when we get to reserves and the effective federal funds rate. Let's start with our money market rates, capital market yields, all of them down across the curve. TLT had a nice week at the bottom down here, up 1.39%. SPX down 2.43%. Finally, TLT doing what it should be doing in a risk-off environment, is getting a bid. Same with ZQ, getting a bid. And the dollar index was strong all week, gave up a little bit on Friday, but up 1.27%. TLT finished firmly above 90. Nice to see. The high of the year, April 4th, 92.85. We're still about $2 and change away from that. But if we can hold the 90s, there might be some promise here. Depends on how we open. The probability of a rate cut in October increased 97.8, almost 100%. We get that in 17 days. The only data point that we'll really get for that one, given that we have a shutdown, but that may end Monday, Tuesday, Wednesday, who knows? But if the government's still shut down by the meeting, the only data point they'll see is CPI, and this will be released on October, I believe I saw October 24th. That is the Friday before their meeting. I think somewhere else I saw a 28. That would be the day before their meeting, but I think it's the 24th, October 24th, the Friday. And there's our probability. If we have really benign CPI and the government is still shut down, maybe we see a 50. Maybe we see that. Beige book in 3 days. Normally, this would just be sort of, it's mostly anecdotal stuff, and mostly this would just be, not really given a lot of weight, maybe referenced here and there, but not given a lot of weight. But being that we have no data from other government sources, we're going to be picking apart whatever it is that we can get. We got a lot of Fed speak this week as well. Tuesday, Powell is in there. Mirren is in here 3 times, once on Wednesday, twice on Thursday, but twice he's spoken, and I've watched ZQ and I've watched ZB, and nothing, not even a tick while he speaks. The market just ignores him, so I don't think that he's an important one to listen to. Your important ones here are Bowman, Powell, and Waller, with Powell becoming, I think, less important. Here's something big that's brewing. Reverse repos are 4.12 billion. When it hit its peak, it was like 2.2 trillion, and it's gotten itself all the way down to 4 billion. This is the lowest level, and probably is going to hit the zero line at some point over the next week or two. Reserves sitting just around 3 trillion. I was thinking that 2.5 trillion was probably a place of ample reserves, although I'm not too sure that it's that low. It might be closer to the 3 trillion. And the evidence here is the effective federal funds rate is now 4.10. That is an issue. It was 4.08, then it creeped up to 4.09, then to 4.10. This is usually fairly stable. It should be at 4.08 all the way through. Now, 4.10 still not anything to get worried about. The range is 4 to 4.25. So this can climb another 15 basis points. We can get to 4.25. 4.26 would be unacceptable. This would highlight to the Fed that they need to step in and do something. But you've got this reverse repo that's coming down. You have reserves that have gone from 3.3 to 3.2, 3.1. Now we're at 3. And you've gone 4.8, 4.9, 4.10. It is creeping up. So I would say that we're probably approaching a level where the Fed might want to say, okay, that's it for balance sheet runoff. And if this thing keeps ticking up a basis point every 2 days, every 3 days, at some point you're going to have to start buying treasuries to replenish reserves, to push the level of reserves up if you want to stay in the ample regime. Nobody knows where it is. It's just a guess. But the last time they approached what they thought was ample, just a little under 2 trillion, the effective federal funds rate started shooting up. Well, going from 4.08 to 4.09 to 4.10 within a week. I think it was about a week to move 2 basis points. Doesn't sound like a lot, but this thing doesn't move. And here we are, 4.10. So we have to interpret our cuts, not from 4.08, but from 4.10 now. We have 96.4 on the January ZQ, implying a rate of 3.6. We're at 4.1. There's your 50 basis points. There's your 2 cuts. One for October and one in December. Q1 has got 24 basis points in there. And in Q1 we have January and March. We have 2 meetings. One cut in there. Q2, 21 basis points. And for Q2, there are 2 meetings in there as well. One without Powell. And then Q3, another 16 basis points. And you'll have 2 meetings in there for Q3 for a total of 112. Basically 4.5 cuts in 8 more meetings. 2 cuts in 2025 we're going to get, 1 in Q1. I think that is not unreasonable, which means 1.5 post Powell. I think that's unreasonable. I think that's where the market is wrong on this one. I think it's going to be a lot more than that. I think the market may slowly be coming around to that. You had last week one hawkish Fed official that is now signaling that, maybe cuts are the right thing to go. And the longer this shutdown lasts, the more likely it is to cause bigger damage. Reductions in force have begun. That's a signal for labor market. You had a bunch of buyouts that already happened, so I think government payrolls dropped by about 100,000. They ran off, I think, in August or September. I'm not sure. October jobs report, if we had got it, would have told us something there. But we don't have it. ADP is negative 32, but they don't count government jobs. So if this is still in play by the end of the month, I'm thinking maybe why wait till December to get your other 25? Clearly the market could use 50 right away. Now, this is not even going into what's going on in private credit. You have 2, and in the automotive sector as well, 2 bankruptcies based on, looks like illegal accounting practices. Tricolor and some auto parts company, and I had the name 30 seconds ago. Now my brain just withheld the name of it. But if we want to think about what this might signal, have a look at what a Minsky moment is, right? This may be our Minsky moment for this cycle. Real yields, all of them down across the board. All break-even rates are down as well. Look at that on the 10-year, down 8 basis points. 10-year real yield to 1.75. OAS all have widened. That seems to make sense to me. High yield 2.95. Where's our triple C? 8.38, still in the 800s. That seems a little complacent. Mortgage rates 6.3%. The only data we get this week is housing market index, NAHB housing market index for October. It has been sitting at 32 for a couple of months now. That was the previous reading. We get this on Thursday. And mortgage apps we get every Wednesday. The last reading was negative 4.7% from the week before. And corporate bond issuance, this is for the month of September. Look at the issuance this September versus last September. Investment grade, 202 billion. Last year was 190 billion. High yield really came out big, almost 57 billion here, up from 40 billion. And even convertibles hitting almost 24 billion, up from just a little under 9 billion. Lots of debt issuance, but I listened to Real Yield this week. Apparently debt issuance for October has really just fallen off. Let's have a look at copper and aluminum. Two separate metals, but they do have a substitution in some applications. In some electric applications, you can substitute aluminum for copper, so they don't get too far out of line in terms of price. If you look at a ratio of copper prices by the ton to aluminum prices by the ton, the ratio has a mean reverting level of around 3.5. We're running close to 4 on that right now, meaning that copper is significantly overpriced to aluminum, and there is a substitution between aluminum and copper. Let's look at how we got here to figure out where we might be going. Let's just look at the chart, 1, 2, 3, and some of the points that I picked out here. This was Liberation Day. Everything took a dump, and then aluminum recovered and copper recovered. They tend to move in the same directions. This is Freeport shutting, not Freeport, sorry. This is the announcement of tariffs on copper, that copper will face a 50% tariff coming into the U.S. And of course, aluminum is going to get a bid on that because the thinking is at that price we'll substitute aluminum for copper. This is the removal of that threat, and there is aluminum giving back. And then you have this movement in aluminum along with this movement in copper. This point right here was Freeport announcing the Grasberg mine is going to be offline for the rest of this year and much of 2026. They supplied 3% of the world's copper. And then you have another leg up over here on Teck. They lowered their copper production guidance for 2025, primarily due to Chile, their mine in Chile, but some issues in Canada. New target 415 to 465 thousand tons, from 470,000 to 525. Take the midpoint of each, and that is lowering your production by 11.5% on top of this 3% shutdown. So that drove copper prices higher. But what really pushed it higher was also aluminum having this run up. Copper will pull up aluminum, but something happened in aluminum that forced aluminum up, which pushes copper higher. Copper had breached $5.25 a pound, and Freeport had dropped all the way to $35 on this announcement and ran all the way back up to $44. Basically $2 below what its price was before the announcement. But of course, copper going from $4.50 all the way to $5.25. So the remaining stuff that Freeport would sell at significantly higher prices. So up it went, and then Trump sort of ended all of that. So you do have a deficit in copper. The demand for copper is greater than the supply of copper, or at least going into the next couple of years, the belief is that the demand for copper will be greater than the supply. And you've had some significant hits to copper. You had the Panama mine last year, 5% of world output just shut down. Grasberg, 3% of output offline for a while. Teck, 11.5% of their output gone as well. Let's see what happened with aluminum. Fire at Novelis aluminum plant in New York, September 16th. They make automotive grade aluminum, but Wall Street Journal didn't run a story on this till October 7th, so it didn't show up in a lot of prices until they ran that story. The plant will be offline until Q1 of 2026, and they supplied Ford, GM, and Stellantis with heavy supply for Ford, and analyst estimates that about $1 billion hit to earnings from Ford because they now have to go source aluminum somewhere else. This plant supplied 40% of aluminum sheet used by automakers, and that pushed aluminum higher, which also pushed copper higher because of this substitution effect. After Wall Street Journal ran the story on October 7th, on October 8th, Ford dropped 4.8%, GM dropped 1.7%, and they were hitting 52-week highs. After the story and to closing on Friday, Ford is down 10.43% from its 52-week high, and GM is down 10.33% from its high as well. This is an event, not a trend. This is just an event. So I see this as a buying opportunity, not so much for Ford. I'm not a big fan of Ford, but for GM, I see this as a buying opportunity from 62 down to 55. I'm more than happy to pick up some GM here. I kind of hope it goes a little bit lower. The forecast on aluminum is for a deficit into 2026, all the way into 2028, and maybe up to 2030 is a deficit on aluminum. Aluminum takes a whole lot of energy to make. And there's one area in China, in Yunnan, Y-U-N-A-N, called the Aluminum Alley. But there is a cap on production from Beijing, and it is believed that Beijing will not raise that cap on production because you would be taking electricity away from other things to make aluminum, such as data centers and things that are more important to China right now. So it's believed that that cap will hold, and if it does, then you hit a deficit in aluminum. That would drive aluminum prices up, which would drive copper prices up. And anything that drives copper prices up will drive aluminum up because you do have some substitution effect. So where are prices going to go? We're not really quite sure, but if we think that aluminum may outperform copper going forward, then you would do a trade by the ton. You would price out copper by the ton, aluminum by the ton, and you would price it based on what a 1% move would be. So 1% move in a ton of copper equals how many dollars? From that, you'd figure out what a 1% move in aluminum would be. You divide the two, and there's your hedge ratio. I'll show you how to do that with silver and gold, because I think that is the better trade on silver and gold. As far as aluminum and copper, I do think a long copper position makes sense, and if you have a long copper position, probably a long aluminum position probably makes sense as well. And with this case, in a case like that, you're just really looking at long one contract on each, or however many contracts that you want. If we have a belief that copper is going to go much higher, it will be substituted more for aluminum, which will push this much higher. And if we do have deficits expected for aluminum and we know we have deficits for copper, these price squeezes probably go higher. Let's look at gold and silver. Gold closing at $4,000.41. After hours, it moved higher, moved up about another 1%, another 35, 40 bucks. Silver closed at 47.25, but it did peak above 50. The chart that I have up here is the ratio of gold to silver. There is 100, there is 70, there is 50. 50 used to be sort of a mean reverting level for that ratio. It has now moved closer to 70. And 100 is an extreme level. So 100, at 100, we would expect that silver would begin to outperform gold. And at 50, you'd expect gold to begin to outperform silver. So at 100, you would go long silver and you would short gold. And at 50, you would reverse it, as opposed to thinking, is it too late to buy gold? Is it too late to buy silver? I don't know the answer to that, but a pairs trade on this makes a lot more sense than trying to go long one or the other. Let's just look at where we are on the two. Gold closed at $4,000, and gold is a byproduct of copper mining in Grasberg. So some gold is now being taken offline, some gold production taken offline, because it is mined as a byproduct when you're mining copper. At least in Indonesia, at least in the Indonesian mine, it's a byproduct, and it was 3% of the world's copper. So if you're not taking that copper out of the ground, you're not taking all the gold out of the ground that comes with it. The more interesting story is in silver. Silver is both a precious metal and an industrial metal. To isolate the two components, you can regress a series of silver prices against gold prices. You get an R squared of 0.68, with gold being primarily a precious metal. So what moves a precious metal moves all precious metals, or at least we can sort of simplify our thesis that way. 68%, the other 32 must come from industrial use. But silver has 60%, 60% of silver itself is for industrial use. Photovoltaic, EV, and electronics. Demand is greater than supply. This was the July to September period. Demand was greater than supply. You have declining ore grades in silver, much as you do in copper, much as you do in gold. And you've had underinvestment in exploration, much as you've had in copper and much as you've had in gold. What complicates silver more than copper and gold is 70% of the supply of silver is a byproduct of other mining. So in South America, for example, Freeport has some mines in South America. The byproduct is silver. In the US, the byproduct is small bits of silver, but mostly molybdenum, and in Indonesia, it is mostly gold. But 70% of the supply of silver is a byproduct of mining for other things. They're not there for the silver, just silver happens to come up. And of this 70%, 20 to 25% is a byproduct of copper mining, and we've already seen that copper is having some issues with both Freeport and Teck Resources. So that's going to hit silver supply, which is going to make the demand and supply balance even worse in the favor of greater demand over supply. So there is a supply-demand imbalance in silver because it does have an industrial use. And because it does have both a precious metal and an industrial use, the play right now is not so much let's go long gold or let's go long silver. I mean, a bad economy will take down both of them. As we've seen over here, gold gave up $100 on Friday. Silver peaked over $50, closed at $47.25. So it gave up quite a bit itself. The play is the ratio. You're sitting at about 80 If you think that, well, silver probably has more outperformance versus gold, you would be betting that this ratio is going to head down towards 70, which I think is probably the right thinking on this, given that you do have a significant industrial use for silver, given that silver supply is really dependent on other mining. It is 70% of its supply is a byproduct, with a lot of that byproduct being from copper, and we already see that there is some issues with copper, and you do have underinvestment in mining, and you do have declining ore yields. I don't know that I'd want to bet on any one particular miner, although the miners will do well. But both gold and silver have had an incredible run. Is there much more? Silver's been at $50 before, and then that was it. That was it. Thank you very much, silver. We'll see you later. So is that it? Or should we play this ratio? On the next screen, I'm going to show you how to play the ratio and how to size the contracts so that we eliminate the precious metal component and we are long the industrial metal component of silver only. And I will tell you right now, do not attempt to do it by ounces. A silver contract is 5,000 ounces. A gold contract is 100 ounces. Do not think that this is a 50-to-1 hedge ratio. You will get crushed. Okay, what I'm going to show you is how we can set a hedge ratio for gold and silver such that we hedge out the precious metal component and that we are long the industrial component of silver only. This is from derivatives trading for U.S. metals, silver versus gold, which if you are an applied level subscriber, under applied asset management, under trading manuals, click on the folder for derivatives trading. This will be up Wednesday. I cover gold, silver, platinum, palladium, copper, and aluminum. Energy is already up there and grains are already up there. This one is 91 pages long because I'm covering 6 metals. Energy was 46 pages, grains is 55. So you've got about some 190 pages related to 3 big categories of derivatives: energy, grains, and metals. Let's look at what we have. We have a ratio that's sitting at about 80, and our thesis, because you always have to have a statement of thesis. What is it that you believe? And let's say our thesis is that silver will outperform gold over the next quarter. So we don't necessarily say that we have any target that it's going to 70 or going to 50, only that silver will outperform gold over the next quarter. The ratio, we think we might have an immediate take profit at 70 or a take profit at 50, or maybe we take half our profit if it gets to 70, the other half if it gets to 50. HG is currently at $4,000. SI is currently at $47.25. How we size these to get rid of the precious component is we size it to a percent move. So let's lift gold by 1%. That's $40. The contract is 100 ounces, so it would move by $4,000 for a 1% move in gold. What would silver move by for 1%? It's at $47.25, so it would be 0.4725, but it's for 5,000 ounces, which is 2,362. Take the ratio, and there's your hedge ratio, 1.7. Long 1.7 silver contracts, short 1 gold contract. Well, you can't do 1.7. And if you say, well, I'll just round that up to 2-to-1. No, that's not the hedge ratio. It's not 2-to-1. That is why micro contracts, mini and micro contracts were introduced by the CME such that you could get better hedge ratios. So what we'll do is we'll just invert the 1.7 for gold and make that 1 silver. If we were long 1 silver, we would be short 1 divided by 1.17 or 0.6 gold. And we can get that done. GC is for 100 ounces. So if we want 0.6, we just want to be short 60 ounces. That is 6 MGC, the micro, which is 10 ounces each. So we could be short 6 of those, and that would be short 60 ounces. So if we're short, if we decide to go long 2 silver, We would short 1 GC, which is 100 ounces, and 2 MCG, which is 20, and there's our 120 ounces. There's 60 over here. So these mini and micro contracts allow you to set a hedge ratio. If it were 1.73, there is still a gold contract for 1 ounce. So it would be 1 contract for 100 ounces, 2 contracts for 20, 3 contracts for 1. You see where I'm going. Let's just test to see if that's right. Let's push gold up 0.75, and we'll assume that that silver will follow the 0.75. That would be $30 an ounce on gold. We are short 120 ounces. If we took this route, we would be down $3,600 on our gold contract. But silver, we're long 2 silver, so we're long 10,000 ounces of silver. 0.75% would be 35.5 cents times 10,000 would be 35.44. Notice that we are basically even. We are hedging out the precious metal component. We're trying to get zero exposure on that. We are long the silver industrial component only. So we believe that silver will outperform gold over the next quarter. This is the right trade. If gold prices drop 10%, you're short gold. It will take silver prices down, but you're still making the bet that the industrial component will perform, even if the precious metal component does not. You can still outperform on the way down. We're only making the bet here that silver will outperform gold over the next quarter. We're not making any bet on direction. We've taken out the direction of the precious metal by giving us zero exposure to it. And we are just long the industrial component of silver. You would do the same thing for copper versus aluminum, as you'd figure out, well, what is a 1% move in the price of copper per ton, and what is a 1% move in the price of aluminum per ton, and you would size it that way. When you go to the copper contract, you notice it is for 25,000 pounds, so you'd have to size that contract in tons, not in pounds. The other thing I should note about the copper aluminum trade that you do not have to worry about with the gold silver trade is location. LME copper is a very different thing than NYMEX copper. So if you are doing aluminum to copper, you do have to worry about location of the copper, but not for gold and silver. Let's head over to the S&P. Look at that big red bar at the right side of the chart. That is a big move down. On October 8th, the market did hit an all-time high, 673.78. IWM on October 8th hit an all-time high, 246.81, and so did Triple Q. What a difference 2 days make. IJR still got nowhere near its high of 126.73. Forward 4-quarter operating earnings slightly lower at 293.87. Closing SPX 65.52 puts it at 22.3 times forward earnings, down from 22.85. Every time we approach 23, we seem to get pulled back by something. I wonder if that's the administration's line in the sand where they say, hey, we have forward multiple of 23, the market's going to be really jittery. Let's say some shit now, and let's see if we can't make ourselves some money. 22.3. Implied volatility, 13-week percentile, 100%, up from 64. The 26th week is at the 83rd percentile, and for the year at the 82nd percentile. We're looking for rank, if you think better in IV rank, 13-week IV rank 98. That is elevated volatility, that if we believed in the taco trade, this is where we want to sell premium. Premium is at the highest right now. We had pullbacks in everything. I sold some puts on IWM. Because it made sense. I sold some puts on IJR at 114 because that made sense to me. From their high point here, IWM is down 3.65, SPY is down 3.08, Triple Q is down almost 4%, and IJR is down almost 10%. Not from the level of Wednesday, when everything else hit all-time highs, but from their 126, so it looks outsized, but it never got to its 126. I think it printed a 119, maybe a 120 at one point. But we have a market that is down 3.08%. But even at 3.08%, it really only takes us back to just the end of September. So we've really only taken out the last 2 weeks. But over the last 2 weeks, you had growing concern of, are we not in a bubble? Are companies in the AI space not just doing business with each other so they can all book revenues, but it's just one big circular flow of revenue? Isn't that what's going on here? So maybe that was fluff that didn't need to be there anyways. And if we are serious about the China thing, saying, well, that's going to be a big deal, maybe we need to reverse it to some other level. 10% drawdown would put us at 606 on this one. You have a government shutdown. You have layoffs in force that are happening. You have no economic data. And you have a job market that is quite curious. You have trouble brewing in the credit market. You have the effective federal funds rate inching up. You have a balance sheet that might be approaching ample reserves. And it doesn't appear that anyone's in the office. So does 10%, and one more thing, layer China on top of all this, does 10% seem unrealistic to you? We're only down 3%. Put call open interest. This was wild. There's almost three puts for every call. The open interest, and our IV last was 17.8. We were down around 12-13% up to 17.8. The only real data points we have this week to go on are earnings. And of course, they don't agree. We have primarily financials. It is, I'd say 80%, 85% of what's reporting this week are all financials. I imagine they're going to do okay. So I think that this week coming up will be good news coming out of the financial sector, coming out of earnings. Is it enough to overcome what's going on in the market? Is it enough to overcome the continued shutdowns? To overcome the China threats? And that's just the China threat. We haven't heard the threat to the threat that comes back from China, and then the threat to the threat to the threat. Or what's going to happen. Judging by Bitcoin's action Saturday, we would be opening red if the Bitcoin is any measure of risk off. But it seems that is where the big short was concentrated, was in the crypto space. It did drop all the way to 109 before coming back. As I'm doing this now, it's 9:34 a.m. I'm not going to have clarity till 5:15 when currency markets open, and then 6 o'clock when Globex opens, which is 8.5 hours from now. 8.5 hours. What am I going to do for 8.5 hours? I want to see how we open. I really do hope we get some follow through, because these sell-offs with rapid recovery are just really they're really tiring. You'd like a chance to build a position, right? A little bit of follow through on SPY, a little bit of follow through on TLT, a little bit of follow through on ZQ. All I'm asking is for something to completely work out for me, and that's not a lot to ask for here. Let's have a look at who our earnings are coming from this week. And then I want to highlight one company that is on a narrative momentum tear. Just a narrative tear. It has almost no fundamental backing. And when we dig into the lack of fundamentals, it will be shocking. Okay, let's have a look at what we have for the week. And I'm just reading off the screen here. I'm not fact checking any of these. So if what is listed on a certain day, whether it be before or after the market, is wrong, well, you're going to have to take it up with the suppliers of the data. I'm really just reading it off a screen. Fastenal on Monday, 7 a.m., before the bell. So if you wanted to do an earnings vol play on this, you would have had to have done it Friday before the close. Getting into Monday, Canada's closed on Monday, Thanksgiving. Let's go into Tuesday. Look at your banks in here. JP Morgan, Goldman Sachs, Citigroup, BlackRock, Wells Fargo. You got a whole bunch in there. You have Domino's in there, Kinder Morgan, and Johnson & Johnson. All of these before the bell opens. So Monday, I will be looking to play some of these on earnings vol. It depends on what vol is. One thing is really nice is we do have elevated volatility across many different stocks right now. If we get a rebound on Monday, that vol will go away, except for the earnings vol. But it would be nice to get a red Monday, to get these guys down a little bit more and get that volatility higher, get that straddle even wider. That would be nice. Let's see if we get that. There's Tuesday, all before the bell. So if you're going to play these, you got to do your setup Monday just before the market closes. Going into Wednesday, where's our financials in here? Morgan Stanley, Bank of America, Citizens. All of them are before the bell except JB Hunt, that's transportation. United Airlines, that's transportation as well, except these two after the bell. Going into Thursday, and I say before and after, I'm just repeating what's on the screen. I'm sure as each day goes by, I will have a better update on who is actually reporting. Bank of New York, KeyCorp, M&T Bank, Charles Schwab, Travelers, that's insurance, U.S. Bancorp, Interactive Brokers, look at that. So you have before the bell and then two after the bell, CSX and Interactive Brokers. And what do we have here on Friday? It should be all before the bell if it's true. Yes, it is. American Express, State Street, Fifth Third Bank, Huntington, Regions Financial, Truist Financial, and an oil services company in here, Schlumberger. So I will probably, just eyeballing these, probably play most of them. I think I might be a little bit selective on some of them, but probably a good 3, 4, 5 of these per day is what I'll be playing. Okay, let's have a look at OKLO Incorporated. It was up almost $10 on Friday. Was up way beyond that, up like 162. And this was before the sell-off came down to 148. Up $10 on a day when the market was ugly. So you dive a little deeper into this. In Costa Rica, we were using this as a volatility play because its IV was over 100%. It's now up to 129%. It's all story driven, by the way. Whenever you find this kind of IV, don't look for any fundamentals. There usually isn't any. But it had this incredible run up, and then here again, looking for the reason why you have a market cap of almost 22 billion. Canaccord Genuity rated as a buy and raised its price target to 175. That is what caused the rally on Friday as that came out, and boom, up it went. Sam Altman, major investor and is chairman of the board. What does this company do? It is in the nuclear space. Pre-commercial, pre-revenue. Pre-commercial, pre-revenue, which means they don't sell anything, they have no revenue, significant cash burn, very high share-based compensation, which means dilution after dilution after dilution, quarter after quarter after quarter. With significant cash burn, you're going to have more share issuance, more debt that is taken on. Small advanced nuclear reactors. And they will not sell their nuclear reactors. They will sell power through long-term PPAs. So they will go to a customer site and they will set one of these up at a customer site and sell power long-term to them over something like 20 years. Because these are small reactors, they can actually build them in a factory as opposed to build them on site. So it all sounds very good. They'll set up a customer sites, it's like data centers and industrial sites. They're seeking to develop a closed loop nuclear fuel cycle. They can use recycled nuclear fuel as well. One of the advantages of this, the design that they have, is that they don't have to refuel these for like 10 years from the time that they initially deploy them. The Aurora reactor is their small fast neutron reactor designed to produce 15 megawatts. That's quite high. HALEU fuel, HALEU fuel, high assay, low, oh, that's, sorry, that's not F, that's an E, HALEU, low enriched uranium, high assay low enriched uranium, which is 5% and up to 20% U-235 by weight, versus the uranium that is in use now is somewhere between 3 to 5% of U-235 by weight. So to get it to these levels, not widely available at commercial scale at this point. So even if they were okay to go ahead and do this, the fuel is simply just not available. Only Russia and China have major HALEU enrichment capacity. And we know how friendly we are with those two nations right now. This is not the big deal. It would sound like, well, hang on, you're looking for a fuel that really doesn't exist. You have to develop the capacity to get that done. And you would think that that would be the thing that's holding it back, but it's not. Regulatory approval is the hurdle. They were denied in 2022. The entire business is contingent upon approval. So you have a binary risk company here. This is a first-of-a-kind advanced reactor. Estimates are anywhere from 5 to 10 years before you even get to approval. And once you get to approval, you still have to get this input, of which doesn't exist at commercial scale in the US, only in Russia and China. And, well, you can see the problem there. But they are worth $22 billion and on a tear. Price target of 175, pre-commercial, pre-revenue, 5 to 10 years before they get anywhere. Got to get regulatory approval, and you have to solve this supply problem at the same time. That's why it has this kind of volatility. That's the point of this thing, is not so much the price, but the volatility. I think it would be very dangerous to play the price on this one. In other words, playing the delta would be very dangerous. Here you want to play the gamma. I don't know if I'd call this a Vega trade. I don't know that IV is coming down. But your theta is going to be very nice on this. But I would be looking at this as playing the volatility, not playing the price. And if you don't know the difference between those two, I would strongly suggest you do nothing with this thing, because there is nothing other than narrative holding this thing up. When you're playing volatility, you're playing this number right here and the size of the crowd. And for a story-driven stock, these things are dangerous to short, because there is no limit to the story that you can tell. That's why this thing has a $22 billion price tag. And if you want to play the volatility, you need to create the volatility, because playing volatility dampens volatility. So you have to have some way to get that done. Usually it's the bigger firms that are playing vol, and it's usually the bigger firms that are fueling the volatility with stuff like this. You should buy this. Let's put a price target of 175. That is pure fantasy, by the way. That price target is pure fantasy, because you have to guess at when regulatory approval would begin. You have to guess at when commercial supply of U-235 would begin. You'd have to guess on the price. You'd have to guess on the PPAs. You'd have to guess on the price in the PPAs. You'd have to guess on the so many big wild guesses that it's a ridiculous price. It's a ridiculous statement altogether, but it's meant to get you in. It's meant to provide volatility. Because if there's no limit to the story you can tell, oh my God, this thing is going to the moon, until somebody comes along and says, there's nothing here. And down it goes until somebody comes out and says, no, 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 there's a lot here. You're just not paying attention, and up it goes. And it's not as if all these analysts can't figure out what's going on. It's that all these analysts are fueling the volatility because the firms are trading the volatility and not the price. So if you don't know how to play the volatility, I would strongly suggest you stay away from this thing, because this thing can go all the way to $5 before it goes to 500, or it could go to 500 before it goes to $5. But could it go to $5 and could it go to 500? Yeah. So that's the danger of this thing. You buy it, it heads to $5. You short it, it heads to 500. With IV of 130%, it has that IV for a reason. This thing moves, and it moves purely on story. Ignore this. This is fantasy. This is for the crowd. This is not serious stuff. It's for the crowd to say, "Oh my God, I better buy it." And there we go. Tell me what you think about this. If you like this kind of thing, I could try to find, one company a week that I could, sort of present in a light little way like this, just so that we have a bigger mindset about what's going on in certain stocks and what certain stocks are doing. But that's it for this week. We are facing a week, I think, of, there's volatility in my assessment of volatility. We're getting really meta on this. I see no reason why it would just correct itself Sunday night. I've been watching Truth Social all weekend, and there's no reversal of any position. And after the market closed, you had information that you did actually have layoffs. And Bitcoin has taken a dump down on the weekend. I don't see why on Monday we should suddenly say, oh, everything is going to be fine. I think that it will be a taco in the end. But I think we're due for at least a couple more days of volatility, and earnings may come in and save the day.